Hi, Ken from Avvora, and today I wanted to talk a little bit about how much it costs to get your foot into the property market with the minimum amount of deposit. You might be thinking about how much you need to save, and I guess off the back of the transaction costs, which we touched on yesterday, 5% of the property purchase price in New South Wales is a very rough guide in terms of how much you actually need. The LVR though, the maximum that most lenders will go up to for owner-occupied property is 95%. So that means you would need a minimum of 5% deposit to put towards the property. You also need another 5% to put towards the transaction costs, and then the bank will cover you for 95%, which will encompass all the purchase costs and also the transaction costs. Now, when looking at a 95% purchase, which is a high LVR loan or loan to value ratio, we as a broker we tend to caution the purchasers in terms of thinking about what their contingency plans are. One of the biggest problems that you probably encounter if you are purchasing and putting down a minimum of 5% of your own money into purchasing is the valuation of the property might be a lot lower or slightly lower than your actual contract cost. In that particular case, you'll find that there will be a shortfall in the amount that you have to complete the transaction because the bank will reduce the amount that you are allowed to borrow. So they'll base the 95% on the smaller amount, and that'll give you a difference. And ideally, that difference isn't going to be great, or ideally the valuation comes back perfectly as you would expect. But in those circumstances, further funding is required and the transaction is actually at risk. So other things as well when considering purchasing with the minimum amount that you can have, ideally we would like to see people with 25%, so 5% costs and then 20% towards the property, and the lenders will then give you 80%, which means you're not in LMI territory or lender's mortgage insurance territory. Because when you submit your application, the lenders assess or do their credit assessment on your application form on the strengths of your financials, your assets, liabilities, incomes, and expenses. And once they're okay with that, if it's above the 80 to 85% LVR, they actually have to send it off to the lender's mortgage insurer. And from there, the lender's mortgage insurer will have their own credit policies and their own risk appetite and decide whether they want to accept or reject your application. So generally speaking, a strong application is one where there's a lot of surplus income and the amount that you're borrowing in terms of your LVR is low. So that's one thing that can impede your transaction if it does go into LMI territory. So it is definitely possible to purchase a property with 10% of the value of the property that you're wanting to purchase, but it certainly does come with its risks. So that's all for today, and I'll see you tomorrow.